Order blocks inside the trading range will be populated with new buys and or sells. Market maker buy and sell models will form inside trading ranges. Okay, folks, let's take a look at external range liquidity and internal range liquidity and the difference between the two and how we can utilize both. Okay, we have an old high back here, and we have an old area of consolidation or equilibrium. It's about halfway from the low up to this high. Price sweeps above this old high here, and that will be a form of external range liquidity because it's outside the range from this high and the low it's formed. So that was the range prior to the new breakout above this high seen here. So price at this point, we know we have the equilibrium down here, but more importantly, we have clean lows right below there. So we would look for a move that could potentially come down to that level, and price starts to drop, trading down. Now, what it's doing is it's pulling back inside of all these up candles. Okay, so once we clear an old high, we would expect some measure of retracement. And when the retracement occurs, what we're looking for is where's the most logical area for it to pull back down into. Now, if you look at this candle here, we have a previous up candle, rather large candle. Then we have this candle has a wick. So at one point, this candle opened, traded lower. So there was a pass through on the range between both these candles in this area. So the delivery of price was on the up move here and then down on this one, even though it's an up close. It was offered twice all through that range. And price trades here, stalls a little bit and goes right through it, comes back, retests that same level in here, and ultimately comes down and clears out these equal lows. At this moment right here, where is the next level of liquidity? Because we've already traded below this low here. Now, in reference to the low here and the high up here, the stops below these lows in here, would that be represented in the form of external range liquidity or internal range liquidity? In the context from this high to this low, it's internal range liquidity. But from this low to this high, it's external range liquidity because it's piercing it down here. In other words, we created a range from this low to this high. So we expect this range to be given up and run the stops out here. Once that's done, if we are going to go higher and bounce higher or trade higher or even make a new high here, we don't ever know that, we look for the areas of liquidity. So we know there's a up candle here, not the black one here, the up candle, that opening. I'm measuring that opening price and extending in time. And what else do you see on this chart? See this candle's wick and this candle's wick. In between there, price was only delivered on the downside. So we have a fair value gap. So if we start to trade higher, we can expect to see the market want to reach up into that 106.50 level. If it trades through this green candle or up candle, it's going to want to reach up into the high of this candle and the low. So the range that we're trading in now is this low and this high. So if we see price trade up, we would expect it to reach up into 106.25. If it gets through the up candle, we would be expecting it to trade up into this area here, closing that range. And then ultimately it could trade as high as this candle's low. We would be aiming for internal range liquidity. Price trades all the way up right into the shaded area here, right there. Now, because we're looking at a monthly chart of the Japanese yen, we're going to drop into a weekly chart. So we have that fair value gap. Every time the market creates a trading range going lower, you want to mark off the previous high and the new low, and when price trades back up, you're trading inside that range. So if you trade short at a bearish order block, which is the last up candle, that's going to be a return to internal range liquidity. But you're going to be looking for external range liquidity to exit on, which is to stop below the low. Price runs down, hits that, that's where you would look to exit. Predominantly, my entries are internal range liquidity entries with exits at external range liquidity. In other words, I'm buying inside the range and selling it outside the range once it breaks it. If I am in sync with the marketplace and I know what direction it wants to go, and we're framing that based on the monthly chart here, if I'm looking for it to go higher relative to the monthly chart, anytime that the market comes down below a short-term low, I can be a buyer of that on short-term external range liquidity or buying up stops with the expectation that the range will continue going higher, seeking monthly internal range liquidity in the form of this fair value gap. Once you understand on the higher time frame where the market wants to go, you'll be able to frame your trade setups as we drop down into a daily. So we can see the daily chart in here. Market creates a small area of institutional order flow, comes down, hits that same order block, rallies through. Now watch what happens. In the grand scheme of things, in the monthly range, we are trading every time we create a new high, higher, here and here and here, each time making a new high. That is a run on external range liquidity. on this time frame, being the daily. But on the monthly chart, it's still internal range liquidity because you're just inside of a larger monthly range. When we understand where the monthly and the weekly are trying to trade to, when we look at daily setups like this creates the recipe, if you will, low resistance liquidity runs, because you're trading in sync with the monthly, where the monthly will most likely want to see price go up into. So every time a run above an old high is expected, that's going to be framed as a low resistance liquidity run. Every time we see this, you can see how price reacts to it. Very little resistance on the part of price to get through these levels because it has an agenda. It wants to get to a specific price level because the funds trade on the monthly and the weekly basis. 4-hour chart, we can see the highs being ran out. Every high has very little difficulty getting through it because it's framed on low resistance liquidity runs based on the higher time frame monthly. I get questions so many times about how I know where the market's going to be reaching for specific buy stops when we do our live session. This is how I do it. I use the higher time frame institutional order flow to frame out where internal range liquidity is and where external range liquidity is. Where's the buy stops and what kind of stop or what kind of entry am I using and how does it align with the higher time frame? Okay, and I want you to look at how price responds when it gives you a new range. Okay, you got a low here and a high. Price trades down into the previous order block. Where's external range liquidity? Here. So you're buying internal range liquidity with the expectation you're going to see price move to the outside of the range created by this little move here. So that's your range you're trading in for the setup. The exit's here. But do you collapse your entire trade? No. You're looking for the ranges to take out highs, all these highs in here. We get another rally and then retracement. Okay, so it's the last down candle right before the up move. Price trades back down into it. They populate more buys on that order block. Where's the external range liquidity at? Above this high here and over here. Look at the reaction once it gets up in there. Lots of profit taking. Lots of it right in here. The range that's created from this low up to this high. The down candle retrades back into it here. Rallies away. Now, all this is what you're going to have to sit in if you're a position trader. But ultimately, if you give it time, all it's going to do is it's going to return back to a previous order block here, like it did here, and recapitalize more buy orders because it's a long-term objective to get up to here. So they're going to have to buy some here, buy some more here, let some time go by, and then come back down to it again, buy more of it again, and one more time, and then ultimately it runs away because they have their position built in that area. We have a low, price rallies up, comes back down, previous order block, run from this low to where? External range liquidity, buy stops, runs above here. Same thing here. We have a low, price runs away from this consolidation. Why am I not using this low, Michael? Because this is a consolidation in here. Price moves away from that, comes back down, hits the previous order block here, rallies away. What's it going to run for? External range liquidity here. You're looking to buy with internal range liquidity or at a bullish order block inside of a previous range and trying to take profit at an old high or above it while you're in sync with a higher time frame directional bias based on institutional order flow. Because just like any other time frame, the market's going to want to efficiently deliver price. We have a nice liquidity void in here. Price comes down, fills that in, aggressively runs away. The range here from this low up to this high comes back down, retrades back into the bullish order block, buy it on internal range liquidity or bullish order block with the expectation of unloading it at external range liquidity above the range high here. Price trades above it here. Many examples, almost 2 or 3 a week. We have a range here from the low up to this high, trades back down to a previous bullish order block. You can buy it here with the expectation of seeing range expansion to exit on a external range liquidity or buy stop. Because we're looking for buys only, we're going to be looking for any type of impulse price swing up, then a retracement back down into a previous order block. If we don't see any ranges that create new buying opportunities, we can target lows. So you can go through the marketplace and find all of the swing lows and wait for price to trade through them on the downside. And when they do that, they're doing what? Picking up orders to accumulate new longs. Like you see here, right here, right here, equal lows, takes the stops, rallies away. So the type of trader you're going to be is going to be based on what you see easily in the charts. You're going to see either turtle soups, and you're going to be looking for buying of sell stops or selling of buy stops, or you're going to be looking for a return back to fair value, where you're looking to trade inside the range or buying internal range liquidity. In simple terms, let's give you a little cheat sheet list here. You want to be looking at a monthly chart or weekly chart and determine where is the market more likely to go to. And by having that idea, if we're bullish on the monthly or weekly, then we'll be looking for buy signals on the lower time frame. like the daily, the 4 hour, and 1 hour. And we would be looking for bullish order blocks or turtle soup longs with the expectation that any short-term highs on those time frames, that's where the objective is.